As we begin the second half of 2019, and with our collective interest in the housing market, I thought it would be a good idea to welcome back one of our favorite guests to Personal Professional Best, and that is one of the most informed voices regarding U.S. housing and everything housing related in the United States. And that is Doug Duncan, the Chief Economist with Fannie Mae. Doug, welcome back.
Thanks. Glad to be invited.
So we had you on our program last September, and we had you on the program in March, and you made the comments to us at the time about what your thoughts were forecasting-wise going forward. And I know you focus an awful lot here at Fannie on forecasting, and we're glad you do because it helps all of us plan our business. So we haven't heard from you in March. A number of things have happened since with the economy as an overall and specific to housing. What's your forecast for the second half of 2019?
I think it's going to be pretty stable from where it is today. Let me look first at interest rates. The Fed has prepared the market for a rate cut in July. Interest rates are already expecting that, so I don't expect a lot of movement in rates as a result of that because it's pretty much baked in. That's rates at a lot lower level than was anticipated certainly a year ago or even 6 months ago. And so we expect some pickup in refi that we would not have expected in the first half of the year with that come down in rates. How much of a pickup we get in sales is an open question. We don't think that we're going to get back to the same level of total sales as we had in 2018, but there'll be some pickup from the first half into the second half.
So it'll be more backloaded this year.
It will be more backloaded.
Yeah, it seemed like last year we hit mid-year and rates were on the increase. This is in 2018, and when we got to the fourth quarter last year, we pretty much hit the high on interest rates, just over 5%, and we felt the trend slowing in housing. And of course, we've had a reversal where rates started moving down in the beginning of 19, but we were a little slow, and we felt a pickup. So expectations are a little bit better second half this year.
They are, and there's a little difference in the response of the market to those who already own a home and have a mortgage. They tend to be earlier recognizers of the opportunity for a refinance. For people who are in the buy space, that they're thinking about buying a house, that's a longer recognition factor because they're actually simultaneously looking for a house and looking for a mortgage. So there's a little bit of a timing difference between them.
Yeah, that's a great point because those that were getting mortgages in the last couple of years were getting them in the high threes with interest rates and fours. And when we got up last year where rates are about 5, the idea of trading to a new house and giving up the cost of money at historic lows, not such a good idea, but we're now back to those historic lows again. So
that's right.
It sets up pretty well. Earlier this month, everybody was anticipating the unemployment number coming out, and the trend of employment last month in May was down some. This month surprised to the upside. Good news because we do need people to actually have jobs in this era to be able to buy homes. 224,000 jobs added in combination with a 3.7 unemployment rate now and a 3.7 interest rate now. Did you ever imagine in your career, in your lifetime, that you'd see 3.7 unemployment and 3.7 30-year fixed rates?
I remember sitting in my office at the Mortgage Bankers Association, June of 2003, which was the 10-year Treasury rate hit 3.11. And I looked at that on the television screen and I said, will I ever see a number like that again? And the answer is obviously, looking after the fact, that yes, much lower than that. For rates to go lower than where they are today, mind you, in 2016, the Treasury hit 1.6. That was the bottom for the post-crisis period. And there's still a lot of people who are locked in at rates that they took during that time frame. Still at 2%, getting pretty close to that. If the global economy takes a significant downturn, whether it's resultant from trade or other factors within other major economies, that would be the direction that we would go. The U.S. is pretty resilient relative to the rest of the globe, but we're not completely isolated from it, as you can tell from the trade discussions that are underway.
So if rates and in combination employment, a strength of employment, which at this point, career-wise, myself and you, we've not seen anything
This
like
is 50-year lows.
These are 50-year lows on both,
rate.
which are obviously advantages for housing. What are the objections for housing doing even better than it is right now?
Well, the biggest problem is supply. In those unemployment numbers and the high level of employment that we have, the best news in that is that wage rates for lower income households are finally coming up. That's where entry-level buyers often come from, is those folks who are starting out a career or are in categories of jobs which have seen lagging wage growth. So that's combined with this low unemployment rate. But people have to have houses to buy. And the boomers are doing what they said they were going to do, which is aging in place. The Gen Xers, which isn't freeing up for first-time home buyers, that supply. The Gen Xers, who the group that took the biggest damage in the crisis, are also looking and saying, well, you know what? In this house, I managed to survive. I have this piece of land. That's the most expensive part of a house. Why don't I just tear the roof off and put on another layer? They're doing that, so they're not freeing up move up homes. That leaves it into the hands of the builders to increase supply through new construction. And it's hard for them to build entry-level homes. They tend to have built in the past to the move-up buyers. So if people aren't moving up, it creates a supply problem for entry-level folks. And if you look at prices across the country, the low-priced segment is the fastest appreciating in price in every market, which tells you that's where the supply problem is.
Yeah, so in some ways, when I think about it, I almost like the market where it is, where housing is good, it's not great, but with the attributes of unemployment and interest rates, if we did have the supply, we'd be going so fast that at some point, ultimately, then you face the other side of that, the slowdown. So a stable market, arguably for all of us, even with some of the challenges, is better. Earlier this month, the Fed chairman came out and talked about what's next for interest rates. Everybody was anticipating that. And of course, dovish. I asked earlier, before we got on this morning, does he really have a choice at this point? Because both, the president in some ways is influencing or bearing influence that's not typical. And then also you have the other side of it, which is the market's already pretty much moved, anticipating. What are your thoughts on the Fed right now and what their next move is, if you will?
Well, in our forecast, we have, for the remainder of this year, we have the Fed cutting a quarter point in July, really as an insurance policy. And we would expect them to, after they make that move, to then go into messaging suggesting that it was an insurance, that they're ready with additional insurance should it be merited. But we don't expect them to make another move until December. And then we do expect another quarter point cut in December. Part of that is we've been a little surprised that the market hasn't appreciated the slowdown in the way that it's been built into our forecast, for example. This is not new. If you look at our forecast from 18 months ago, you'll see pretty much the same profile as we've got in the forecast now. So it was our expectation that the economy would be slowing, and we thought others shared that expectation. Obviously, the markets didn't. The market is to some degree self-interested. We're at very high levels of equity valuations, and certainly the Fed is going to attempt to message after the July movement about whether or not that's a factor in their thinking, or if it's more so global uncertainties related to trade and the level of growth in other economies like China and Europe, for example.
Perfect. That was my next question. So, of course, there's lots of information in the news. We talked earlier about that as well, just all the different inputs that you use in your forecasting. One of the things that's out there now that conversationally is probably occupying a lot of at least folks like yourself is the U.S.-China trade conversation. So to the extent that that's out there and seemingly is going to either get better, where we get a trade agreement, or not so much, we continue the current dialogue. What are your thoughts about how that affects the overall economy and then specifically housing?
Well, the U.S. is the least sensitive to trade issues of any of the major economies. In other words, a share of our national income which comes from trade is smaller than it is for other countries. That gives us an advantage if we're having a negotiation over trade. It is a lever that you can play, but it's not a costless lever because ultimately it's consumers that pay the price. Let me just make one comment about free trade. What we have not had historically in my lifetime or even before my lifetime is free trade, where there are no restrictions on who can trade what with who. What we've had is managed trade, and that process of managed trade has gotten to more free trade than previously over the last 50 years. I think what we've reached is the peak of freer managed trade, and that's what's under discussion today. The relationship with China is more than just about trade, though. It's about global shipping lanes, international security, about intellectual property rights. It's actually much more complex than whether or not they're buying our soybeans or we're requiring tariffs on imported goods from China. So there's a little bit of a misimpression in the press about exactly what's going on with China. That's going to be a long-term thing. I would say 20 or 30 years we'll be having this discussion. It's not just this administration.
Got it. So on the margin, maybe it's not as economically impactful as we hear in the press, that is our conversations with China. But if we did get an agreement that felt like people were participating, collaborating, that would be beneficial.
It would reduce uncertainties. So the Fed had commented on that appropriately, that one of the things that's holding back business investment is the uncertainty in the investment climate for companies that have international relationships. So an agreement would reduce that level of uncertainty and probably increase investment in the U.S. economy.
So give us one or two things that we should look for that, if took place, would benefit housing, the economy and housing at this point, and maybe one or two things that, if they took place, would negatively impact. As we think about planning our businesses, it's always good for us to put those inputs in.
Sure.
So we can be aware and watching what folks like yourself who are experts on the marketplace tell us what we should be looking for. So one or two things.
I think what we just talked about trade, it's not just trade with China, but also the discussion of tariffs on autos with Europe. That goes right to the heart of Germany, which is the engine in Europe. And Mexico, frankly, is our biggest trading partner, and they're our neighbor to the south. So trade relationships with them is very important to us. So not just China. A second thing to think about is really in the housing space, is there anything that can be done to improve supply? Because that's going to be the linchpin, particularly for the first-time buyers, and it is first-time buyers that are driving the market at the margin today. So within the mortgage space of that, which is where both of us reside, you have two or three things going on. One is the issuance of a single security that is now mortgage-backed securities backed by both Fannie and Freddie in guaranteed loans. That's an experiment that got launched at the beginning of June. It seems to be going well. It has the potential to unsettle markets if it doesn't go well. There's not a reason to think that it won't, but that's a pretty important structural change that's taking place in the mortgage industry. There's also a discussion of the privatization, the potential privatization of Fannie Mae and Freddie Mac. I think that while people are paying attention to that, I think that's a longer term consideration. The administration would like to see that. I think taxpayers would benefit from more clarity and moving us into the private sector and clarity on the government's role in housing. I think that would be a healthy thing. There'll be discussions on that ongoing. Probably not something to get upset about, but just to monitor because it's core to our business. And then finally, what the Fed decides to do, because housing, as we saw with the rate rise in 2018, is sensitive, perhaps more sensitive because it's so involved with first-time buyers than it has been in the past. And the profile with which Fed sets rates will have a lot to do with where our industry goes.
So I know you said last time you like to be accountable to your forecast, and you're right on schedule so far this year. Still 1% to 2% year over year or is it about flat year over year from 18 to 19 number of home sales?
Our the forecast right now is about 1% up this year. There's a chance we won't make that.
Got it.
And if a lot of it depends on what happens with rates, because there was a bigger response to the rate rise in 18 than what we would have expected, and there's been less response to the decline in rates than what we had expected.
Interesting. Last question I always want to ask you is this, because my business and those that are watching today in the real estate industry, whether you're representing sellers or buyers, in large part what we do is consult, we give advice, and oftentimes we get asked the question, is it a good time to sell? Is it a good time to buy? And I always love asking you this question because I think about that in terms of the consulting that we would give and how we would give it, because we don't want to be perceived as selling anything to anyone. We want to be in a position if people want to sell and buy, that we're giving them the very best advice. So if it was somebody really important in your life, your kids or your best friend that called you and said, Doug, is it a good time to sell? Is it a good time to buy? What do you tell us?
Yeah, there's two things, one of which I didn't talk to you about before because we just released a study on this. We did a study at the end of 2018 to compare it to a study we did in 2015 about the understanding of what it takes to qualify for a mortgage. There's been no improvement in that. People still don't understand the credit score.
We know that.
They don't understand down payments, all that. So that's one thing that your folks will have to coach folks through. But the principles about financial management don't change. If you have a family budget, which you should, then have a budget at today's interest rates and the house that you're looking at. Does it fit the family budget to make the mortgage payment that would be required to acquire that house? And if it does, then make the move today, because if rates fall, you can refinance. You have the option to refinance on that and get a better mortgage in the future. But if you don't, if you're betting on where interest rates are going, now you've moved from financial planning to speculation. Can you afford to be a speculator?
Bad idea, right. Take the emotions out. If the budget works and you can afford it, then it's a good time to buy.
That's exactly right.
Doug, thank you so much. We really appreciate you taking the time to give the real estate community the insights that you do. And we appreciate the forecasting you give us because it helps us as we think about planning our business. So thanks for being a part of Personal Professional Best.
Thank you. My pleasure.